Starting us off right now is another keynote speech by Roberto De Meo, Vice President at Visa Consulting, and he'll be talking to us on leveraging data to unlock business value. Roberto, you're free to come to the stage.
Thank you very much. Good afternoon, everybody. I'm happy to be here with all of you. I'm happy to be here at the Data Science Conference, not the first time, always a reinvigorating event to be part of. Let me just quickly introduce myself. I'm part of Visa Consulting and Analytics, which is the consulting arm of Visa. We provide advisory, largely data-driven and database to the main partner of Visa. So financial institutions, but also increasingly more and more merchants, government, fintech across different industries. I need to ask you, please don't take pictures to the slides. For some information they'll be included, but you can ask as many questions as you want. I will try to deliver the presentation faster than the 40 minutes to leave a bit more time for the Q&A. So what do we cover today? We will touch how financial institutions and sellers are leveraging data, what we are seeing happening in the world, and how the use cases to exploit value out of data is increasing year after year. And we will also give a view on what in Visa are we doing to capture these opportunities, and not only what we are doing, but providing you with some concrete examples of a way to implement the use cases I will be mentioning in the first part of the presentation. But let's start with a short icebreaker. A couple of questions for you. Anybody has a guess on this? How many years it will take to download the internet?
Probably the biggest one.
You're right. Today, around 2.5 quintillion of bytes are uploaded every day to internet. So the second question is, how much of the data available is structured? Exactly. And this percentage is shrinking more and more. If you think all the unstructured data that are going to social media or the metadata included in some of other applications. And then this is easy. I will not even ask. And data science, steadily, together with cybersecurity and the program management, is one of the most on-demand skills on the market. And what is interesting, and there is a coincidence between what people are key to learn and invest on, and what is actually sought after by the employers. And last but not least, how much time data scientists spend on data analysis? A recent study of IBM showed that this percentage do not exceed 20%. Why? Because the large majority of the time is going in data structuring and cleansing, raising the need and relevance of data quality as one of the big aspect in the data science industry. And also more than 60% of the data, once structured, is actually not used to perform the analysis that are needed. This is to set the expectation how there is a wealth of information that is expanding, but is expanding in a complicated way due to the structuring, due to the infrastructure and the governance and process enablers that needs to be in place. This is not new to you. Financial institution and seller use driver to drive business impact. What is new is that the use cases are progressively expanding every year. We tried to catalog them in 4 macro categories. One is the optimization of customer acquisition, campaigns, target audiences, customer value proposition. The second one is increasing the customer engagement, both in interaction through GenAI-based tools like chatbot, but also more traditional campaigns that are progressively supported by the advanced data modeling. The third one is risk management. We will touch upon this a bit later. Here is critical because we see an explosion of the fraud level concentrated on alternative new rails of payment and e-commerce, which is obviously growing and is bringing with it an increase in frauds that require a strong attention of the institution. And digital transformation, not only in the sense of transform the company to be able to exploit data, but also using data to drive better decisioning in how to transform the company. A couple of numbers. If we look at this example is based on the North American market. Investment in data solutions account for 200 million. What is interesting is financial institutions are just a small part of it. The lion's share is held by sellers, by merchants. And definitely within this spending, more than 50% is on the digital advertising. But even if we take out the digital advertising, this multiplicator of sellers versus financial institution is still massive. It moves from 20 times to 10 times. This is why also as Visa, we are strategically more and more repositioning, well, not repositioning, we still work very hard with the financial institution, but we are trying to grow our cooperation and the type of services and products we develop for merchant, because this is where the industry is going in this space. And definitely it is paying off. Looking at the Standard & Poor's 500 index, the companies that are recognized more advanced in terms of data investment, data infrastructure, and governance are outperforming by 1.6 the other companies. The list of players is endless, and we can stop to artificial intelligence tools, move to more recent Gen AI, but you see a lot of the big names that already since many years heavily invested across the different use cases I mentioned in previous slide. JP Morgan with Coin, which is contract intelligence, is working on the optimization of the lending contract. This drove a significant reduction in the mistakes in contract finalization, therefore reducing the time to market, reducing as well the operational cost linked to the underwriting of the contract. OCBC was one of the best results in terms of alternative credit scoring using a larger set of data. This resulting not only in a reduction of the cost of risk, but also in a time to response reduced by 60%. HSBC is one of many that invested in Gen AI chatbot to improve customer experience. It's called EMI. But I can mention also Fargo from Wells Fargo that operates in English and Spanish as well in the United States. And Capital One, closer to home to the card and payment business, managed to have a significant improvement in the performance of portfolio optimization and life cycle optimization of the client up to 30%. Now, in this scenario, what us in Visa are doing, what in general the payment industry is doing. Obviously, data is our biggest asset and is the reason why we are here speaking to you and talking to you. I will not go through the detail of the slide, but you understand that the size of the data that we control in our system is massive and provide significant value in terms of counterparts, transaction, geolocation, and some additional information that we are progressively including. I'm thinking about the travel industry with enriched data on air traveling. So, which are the key priorities we are trying to address with data? Back to what I said at the beginning. First of all, how to attract customers, how to retain them, how to engage them more, and how to retain them, balancing a cost of risk that in different forms, credit, operational risk, cybersecurity, is growing increasingly. I will address one of each of these independently. Let's start from point number one, attract customers. At the end of the day, the questions we typically receive from our partners are two. How to use data to better understand the market we are playing in. And the second one is how we can leverage this information to attract new customers, to open a new addressable market. I will bring this to life with a concrete example. This is a project we did for an international taxi hailing company, and we run it across multiple countries of Europe. And the project was structured exactly around the two pillars I was mentioning before. First one is understanding the market positioning and the performance. So we look at that, which is the performance at the micro segment, going down to specific cities. We set up a data engine that would provide data feeds on a weekly basis with all the information to adjust the marketing campaign, the potential offer, with this information covering different cities, not only different countries. And we also tried to understand how the penetration differentiated across different categories of customers, specifically the foreigners, because what we noticed was that the penetration on foreign customers was actually lower than competitors, most likely for a brand awareness constraint that required some significant investment in marketing, in awareness, and also in offers. The results were 5 percentage point of market share increase and up to $500,000 of weekly return. But this was only the first part. This was just understanding where we are sitting, what we are doing now. The second half was, how do I grow now the customer base? So we created a detailed group sizing city by city, so concretely which are the personas and how we can address this through a behavioral segmentation. And also we understood which strategically could be partners that make sense to collaborate in creating joint offers, creating mutual referrals. We identified up to 10 million of incremental addressable market. Interesting was the mid-cities. What was interesting is despite the lower awareness with larger brands, the major gap was in the mid-cities, not in the large metropolis. But at the same time, we noticed that new customers were 4 times more likely to get the incumbent rather than the new player. And we identified incremental spending, also leveraging the partnership we identified and mentioned it in the previous point. Let me then move to the second point, which is engage, keeping the customer engaged with personalized offers. Here, the key word coming to my mind is loyalty, is how to leverage loyalty at best to keep customers engaged. And performing loyalty systems is deeply rooted into a solid data infrastructure and analysis. In Visa, we moved from traditional rewards platform that you can imagine the typical exchange of points across earn and redeem points to more sophisticated tool like personalized card offers that obviously require a personalization, hyper-personalization of the offer at customer level, benefit platforms that allow a Tetris approach to create different benefit and can work on both sides, on the issuing side, on the bank side, creating different blocks for different personas, but it can also be operated by the customer, giving you a balance of benefit points, let's say, and by yourself you can decide whether to invest in cashback or in lounges or in other benefit, restaurant discount, I don't know. Obviously, you understand that without a tight control of the data, the risk of overspending and limited ROI is very, very high. The final step was development entire end-to-end platforms that would support the client from the data ingestion, so managing the customer life cycle, but also having all the loyalty and outbound campaign initiatives embedded on it. Obviously, also in this case, I will be very fast. The credentials and the data are at the cornerstone of this. I will not repeat myself, I showed a slide before. But I bring to life with another example from this region, not Serbia, but another country in the region, where we deployed this type of end-to-end platform going from the data structuring of Visa and bank data to create a customer lifecycle view that would enable specific loyalty and campaign initiatives. We started working on co-brand card, so card co-branded by a major bank and a major retailer in the country. And this allowed to have a significant uplift, not only in the activation, so how many cards are really used once they are sold, but also in terms of transaction and spending. But the byproduct was that this campaign allowed also to address the existing customer base, driving up to 50% incremental spending on the other card. I now move to the third point, which is retain customers balancing the cost of risk. And part of the retention, in reality, we already touched, because having a good customer experience, a good loyalty, receiving relevant offer is already one of the key elements to retain the customer. The problem is in a context of increasing risk, and I will explain why I mean so in 1 second. This type of investment, because at the end of the day, pushing this initiative is an investment, should be paired with a tight risk control. Which risk I'm referring to? I mentioned it at the beginning, but here I will go a bit more in detail. We have fraud rates that are 7.5 times higher in card not present transaction. E-commerce. E-commerce is booming, so automatically the frauds in card payment are increasing. And this not only cards. In the slide you see the numbers related from card, but if you would consider account to account, through real-time payment system, this level of frauds is even higher and growing given the higher penetration of RTP. Crypto, despite the volatility of the transaction, we still see an increase also on the frauds in that space. These represent already around 90% of all the fraud in the market on the most lucrative part of the business. And here, there is this small point at the lower right corner that opens up to the other slide. This is the tricky part that creates a vicious circle. It's easy to stop this fraud risk with very aggressive risk policies, lowering the risk appetite. But this would have serious impact on the customer relationship, because for every decline of a transaction, you have a multiple of these that are false positive. Transactions that are not real frauds, but they are caught in a higher risk appetite. The impact of the business is negative, because 2.5%, the cardholders that went through a decline, a false decline, are 2.5 higher risk of attrition. And this gives the circle that I mentioned. The more threats are driving to more risk to frauds, needing a push that, if limited to reducing the risk appetite, would create friction and the false decline. So at the end of the day, this would result, the impact on the attrition or losing the client on transacting less could be more than proportional to the direct cost of the fraud itself. Why I'm making this point? What are we doing with data? Because what we are doing is try to combine our value-added services that are based on machine learning model with rules optimization. We basically set up a real-time rule for all this system of approval or authentication of the transaction, aimed not only at improving the capturing of these frauds. In this case, this is an example, but pretty much a standard in terms of KPI of project we run. Our system managed to double the detection rate of frauds that historically on the clients is in a 25% range. So only 1 out of 4 is captured. We managed to double it, bring it to 50%. But what is more important, it drives a massive reduction of the false positive. So the lawful clients that are not impacted increased significantly. And this drives, on top of the $2 million in this specific example on bottom line, straight profitability, because we release a big chunk of transaction that they might not happen otherwise. You have also a much wider, but hard to estimate, frankly, benefit of long-term retention of the customers. They keep the level of spending, they have a higher lifetime value, they keep engaged with the institution, maybe a bank, but the same applies if you are a large e-commerce merchant, longer term with you and driving revenues. In closing, this was not supposed to be exhaustive of all the use case on everything that we done from the data, but it was meant to just give you a flavor of how these use cases are evolving, are changing, and have developed more and more. My free takeaway is point number 1, the road to revenues is data-driven. I think we all agree in this conference. The opportunities to unlock value are emerging. We have new use cases every year. With Gen AI, even more, despite all the complication that might be driven by inadequacy of infrastructure, governance, and processes, but still, it's coming. It's not coming, it's already here. And the last but not least, we are here to support and to discuss how data can further enable business. As I say, that was shorter than the 40 minutes. I hope it was not too short, and I'm glad to take
it was fine.
Questions from the group.
Okay, so thank you for the talk. Are there any questions for Roberto? Anyone? Well, it seems that you were pretty clear in your presentation. There's one in the back, if you can please.
Hi. Okay. Hi. I was wondering, so you mentioned retaining customers and engaging customers, but what I'm wondering is, as far as I know, traditionally the cost of customer acquisition has been quite lower than the cost of retaining customers. So my question is, how much are you investing in engagement and retaining customers relative to acquiring new customers?
It's a very good question. I don't fully agree on the statement, and I will explain you why. Because in reality, the acquisition cost, at least when we look at the card business, is the largest component of cost, especially if properly measured. Acquisition and retention together usually account from 80 to 85% of the total cost over the customer life cycle. Now, Let's separate the two because there are strategies to address the former and the latter. When we talk about acquisition, why the perception of cost is... so your point is correct, because there is a perception that the costs are not so high. Because the direct cost per customer acquired, in reality, they are not very high. The problem is the conversion rate. Because it comes with a large cost, even before the acquisition in terms of marketing spending. We saw before 60% of the digital investment is on marketing. So 1 percentage point in click-through ratio have a dramatic impact on the cost per customer, because it will basically distribute this cost across the others. But also the other component is the activation. By activation, I mean is all those customers that receive a card, or thinking broadly that subscribe for an e-commerce site or for any other services, and those that actually use it. Now, a healthy ratio in the card business would be 75% should be active within 3 months. In this region, there is a massive variability. The average is lower, is a bit lower, but there are banks that go down to 20–30%. So again, same discussion. You spent the cost, you formally acquired the client, but the client does not generate revenues. So an activation through campaigns or through a proper customer experience, through a mobile app, gamification is the name of the day at the moment. It's fundamental. On the other end, the retention costs are not linear. The retention costs, I'm now moving to the second block. The retention costs are not linear. The retention costs grow exponentially based on the state of churn of the customer. So the critical strategy is to have models that will anticipate the potential churn of the customers, the likelihood of churn, to enter, to react early stage. Because then the cost of keeping them active would be much lower than for late stage customers, or even worse from what we call win back, when the customer is there on the books, not active, it already opened another account, either a card or again a competitive e-commerce or a competitive system.
Thank you.
I think there are 2 questions here. We'll go with... Okay.
I think a follow-up question on that. I personally agree that cost per acquisition is higher than retaining. Can you outline customer lifetime value in your whole context and how it will help? Because I think it's also equally important, both from acquisition plus retaining, but you look at the CLTV also. Any thoughts that you want to add in the whole construct?
You basically told already, because guys, we should move from looking at specific KPIs to a customer lifetime value. So what you said is correct. You already made the summary. You answered for me. My consideration is still only a minority of institutions really manage to track the CLTV. And back to the point of this conference, which is data science, often the constraint is on the data infrastructure. Especially when we talk about banking industry, especially on legacy banks that have siloed IT system, there is a complexity in uniting this data and calculating a proper CLTV.
No, my point of asking was that I think companies are not actually able to look at that potential and not doing a good job. So CLTV has a lot of potential in terms where all organizations across the globe can do a better job. So that's what I wanted to say.
Indeed.
You are aligned? Okay, thank you.
Yes.
This CLTV is a very close topic to my heart. So.
And I fully align. We can do much more. I mean, a concrete example. We did a project in this region a few years ago on customer acquisition. The customer came to us and he said, look, I have a problem. My customer, in my competitive intelligence, said my acquisition cost is 50% higher than competitors. You need to do something. Now, we fixed it. We reduced the acquisition cost. But in reality, what we managed to calculate is, yes, you have 50% higher acquisition cost, but you have customers that are 30% more profitable than the rest of the market. Because we did not structured, because it was not on the system, but the typical advisory work, pulling data here and there, but we basically realized that probably was also, would have been a mistake, for example, to cut the cost to reduce too much, because they're part of this plus 50% was actually meant to attract the top customers on the market. And after that, they started a process, which is still going, unfortunately, in trying to calculate a proper CLTV.
Really love the presentation because it's super pragmatic and down to earth. So my question is about the new thing in AI that is, you mentioned, generative AI. Would you give us like this down to earth, very realistic opinion on where it stands now, generative AI in business, its application, and how do you foresee its future along its, let's say, development?
It is not future. It is already present. Way to go. Much more can be done, I agree, but it's already present. Several companies are deploying Gen AI. Thinking about the categories where Gen AI is deployed, which again is very similar to the one I presented, which is acquisition of customers, improvement of customer experience, minimizing risk. The fourth one in this case will be driving efficiency. Driving efficiency, so internal efficiency on internal knowledge management, collection and claim management, review of the contract. This is the one that is really more advanced in comparison with the other three. A bit because the expected return is higher, because we are probably they can generate up a 30-40% cost reduction, while the improvement in other areas at the moment are estimated a bit lower. But also because being internal is less affected by ethical and reputational concern, because when it comes on customer interaction, images generation, messages generation, it can create, we had the cases that brought reputational risk. So the companies are much more conservative. Also, truth to be told, a lot of the clients now are we are in a hype situation. So most of the clients are focused to show they are doing something in Gen AI. So they often come to us telling, please help me to develop something. Whatever it is, I don't care, is a chatbot, is a personalized communication, because I want to show to the market I'm doing. And normally they are not very thoughtful on what needs to come before the deployment of a use case. All the enablers that are back, sorry to repeat myself, is always the same. Data availability and quality, data infrastructure, support unstructured data, the type of data needed for Gen AI. Availability of talent in certain region is critical, and also having a proper governance mechanism to manage the ethical risk, to have a proper feedback loop, and all this. And this is the main challenge we have when we engage with companies, is try to convince them to take a step back and look at this holistically. You need to, in parallel, think at the strategy and the use cases to deploy, but you need also to think how to put in place a proper infrastructure to leverage without or with limited risk this type of tools.
Thank you for the questions. Do we have any other potential questions? Oh, right there.
Hi. If we say that some of the companies are not measuring customer lifetime value, what data do you leverage to figure out which customers to retain and which not?
Well, it's a good question, but it's hard to give a standard answer, because the objective would be to try to access all the available data. Because I could easily tell you can look backwards and based on the historical performance historical performance of similar client. You build a lookalike model and you can infer the customer lifetime based on the lookalike. But in principle, the first thing I would do is run a data assessment, what is available in the market, in the company, what is available on a structured way that can tomorrow be converted in a process, in a iterative process, and what can be done one-off. Because the one-off can also be used with bespoke analysis, the traditional tools, not the bank system, and can help to create this lookalike. So, sorry, I'm not very precise, but it's very specific. As I say, the first thing I would do is this assessment, what is available structured, what is potentially available with bespoke analysis, and do.
Can I have another one, if that's okay? Yeah.
Of course.
So if we say that there is a big risk that people will stop using cards, for example, in Visa, what is actually the biggest impact if that risk comes to life? So why is it so important for banks that people use cards, and what is the downside if they really stop using them in the great numbers?
Because the cards are part of transactional banking, everyday spending. So let me come back to the merchant category. There are some merchant categories that are more relevant than others, because if you see that everyday spending is reducing, it most probably means that the card is not top of wallet. It's not the primary card. So it means that the customers most likely is multi-banked. And then the impact would be more than proportional, especially if you're talking about a premium client or a client which is cross-sold on multiple products. Because in some industries, frankly speaking, the payment, especially in European Union with the tight PSD2, PSD3 regulation that put cap, is not particularly profitable, but payments still be a pay to play, because being the everyday tool for the customers is the one that enable the relationship with the client on which you can cross-sell investment products, debit, credit product, lending product, mortgages, and whatever. So it's very important to understand the churn for this reason. For the general impact, and certain merchant categories are more relevant than others.
Thank you.
Is there potentially another question? If not, I think we can call it a close. Thank you very much.
Thank you very much. It was a pleasure.
Thank you as well from the Data Science Conference.
Thank you.